Hi there, I'm Machine Pun Kelly, and today I want to talk to you about the economy. And specifically, I want to talk to you about this disconnect between the economic numbers, which seem to be good, like GDP is supposed to be up 3%, and unemployment is like around 4.3%, and inflation's 2.9%, which is a little higher than we like, but it's not like it was in 2022. So, it's not like panic levels. So why is it that people feel like inflation is so much higher, that unemployment is so much higher, and that job growth is not the same? Like, why do people feel like the economy is worse than the numbers tell us they are? So, first, before I do anything, I want to establish that I'm not just making up that people aren't believing in the economy. This is the U.S. consumer confidence measures. There's the expectations index, and then there's the consumer confidence index. The highest that there has ever been is 144, and this came like right at the peak of the dot-com bubble. Right now, or recently, it peaked right before the election, around in October, and the lowest it's been in 5 years since the pandemic was right after Donald Trump announced his trade war. And now we're north of 90, but if you start getting into um 80 territory, then you're looking at people are worrying about a recession. And so right here it says the recession warning, the expectations index has been below 80 since February 2025, 8 consecutive months. So that's what people are expecting. Like, that's not some economic forecast. This is how people feel. So people feel like we're headed for a recession. And if you want to look at some of the peak dates and things that shaped it, the 108.7 right before the election, things were going pretty good. Then in February, expectations fell below 80, where they've been ever since. In April, it fell down. The confidence fell down to 85.7, and then after Trump chickened out, it bounced back up a little bit, and there was the largest monthly gain in 4 years, but it's kind of the market had the largest monthly gain in 4 years, but it just basically went back to where it would have been if it hadn't been for that. But we're going to look at that more later. There's things that the market is actually lying about, or at least covering up some of the issues here. And confidence weakens to 94.2 as inflation and job concerns resurface in September. Confidence is going down. And so if you ask people, what are you mostly worried about? It's no different than it was when Biden was president. Prices and inflation are the number one concern. 43% list that as their top concern. Tariffs are listed second at 28%. And these two things obviously overlap, but tariffs also imply a lot of things that just inflation doesn't. Jobs, unemployment is third at 24%. Interest rates are at 18. People want interest rates to come down. The issue with this is that this and this are also top concerns, right? So the way that you typically would lower interest rates would be to stimulate the economy so that jobs can happen, right? But when that happens, inflation happens. So if you wanted to bring inflation under control, you would raise interest rates, which would take money out of the economy, which would cause inflation to come down, but it would also cause unemployment to go up. So the Fed's job is always to kind of balance between unemployment and inflation. And there's been, one time in this late 70s and early 80s, there was this thing called stagflation. And stagflation meant that both inflation and interest rates and unemployment were going up at the same time. And so, how do you fix one without making the other worse? And we're entering into an age of stagflation. That's a huge concern. So, right now, interest rates might not be a concern because they're, people are, I think probably a lot of people that are worried about them are worried about them being too high. But if you lower them, then this is going to become uh that problem's going to become better, but that problem's going to become worse. So we'll see how all that works out. And recession fears, 15% of people are worried about a recession. That's their number one concern. Not that only 15% are concerned at all. The current index as of September 2025 was 94.2. Obviously, October is not out yet. Expectations index is 73.4, and inflation expectations. So the next year, inflation is expected to go up 5.8%, which, you go back up here, inflation's the top concern. You can start seeing why that's a concern, right? So there's something called a vibe session, which is this disconnect between what Americans feel the economy was doing when the actual data is telling us something else. We're 8 months below recession level thresholds for expectations. 46% say that they're struggling or falling behind, especially for Americans making under 50K. This isn't a vibe. They're cutting essentials, maxing credit cards, depleting savings, and functionally living in a recession already. And that's the thing I'm going to end up pointing out a lot here. This is not just about feeling. This is about a reality. There is a reality that people are living through a recession right now, and there is a reality that some people are getting richer right now. The top concerns are all driven by Trump policies. I think, and this is important, prices and inflation right now, Trump's policies are driving that up. Tariffs are, he's basically unilaterally making those decisions. Jobs are being affected by the tariffs, which we'll get into. And all of this is making it worse for consumers. And the it's not just that it's bad, it's volatile. It's, you don't know what he's going to tweet one day to the next that's going to cause the market to go crazy, or going to make China not want to do something, or everybody right now is just terrified and walking on eggshells because they don't know what he's going to do next. And I'm not just talking about like voters in the sense of, like these aren't just liberals, blue-haired people. These are people that own companies and employ people, and we'll get into all of that. We're going to explain why all of this is. This is not going to be a short video. Hopefully there will be enough, shorts out of it that you don't have to watch it all at once. But everything I'm saying here, I'm going to cover in detail later. So, don't just say, oh, well, where's your proof? You can't go into detail in every sentence. And personal finances are deteriorating. Personal financial assessments saw their largest drop since tracking began in July 22, with 78% of Americans cutting back on purchases. And I'm going to point out, some of this didn't start under Trump, but it's been made worse by Trump. Some of this started under Reagan, but we're going to go into all that too. Consumer confidence has been highly volatile in 2025, with sharp swings tied directly to tariff policy announcements. The expectations index has remained low, below the recession warning threshold. Blah. Already been through that. Okay. The disconnect between strong GDP and weak consumer confidence reflects a K-shaped economy. Wealthy households doing fine while the majority struggle. So that's what I want to get into next, is what does all that mean? What is a K-shaped economy? But before we do that, I want to show you this. This is the difference between median and average income. And this is not exactly the same thing, but it's shows the logic of what is happening here. So let's say you have these 5 people, and they all make $50,000 a year. All work for the same company. They all make the same amount of money. So obviously, they average $50,000 a year. So they each make $50,000 a year, and the average income there is $50,000 a year. But then this guy Bob gets promoted, and Bob gets a pay raise of $50,000 a year. So now he's making $100,000 a year. To help pay for his promotion, the other 4 are asked to take a $5,000 a year pay cut. They're not happy about it, but in this economy, who wants to go look for a new job? So they all accept it. So now the total amount of money that they all make is $280,000. So that means that they make an average of $61,000 a year. Now, the median income is where half make more and half make less. So this is Fred. He's the median guy. These 2 make more and these 2 make less, or the same. The median income is $45,000. The average income is $61,000. So the average income went up even though 4 of the 5 people and the median income went down. And so what you have here is you have a kind of an economy where one person is doing better, everybody else is doing less. 20% of the people are doing better, 80% of the people are doing worse, but the average makes it look like everybody is doing better. And this is the same dynamic at play with a lot of the stuff that's going on in our economy right now, to where some of the numbers reflect a whole rather than the individual components. And in those individual components, some are doing better than others. So there's something called a K-shaped economy. And what that means is that when you have a recovery and you have different groups that recover at different rates. So typically you'll see like maybe technology industry will recover at a faster rate than the restaurant industry. Maybe that will trail this, or the richer people will do better and the not so richer people will do worse until the recovery starts to catch up with them too. So this is called a K-shaped economy because you've got like the 2, I don't know what you call them, tails, like these kind of tails you have on a K. So it looks like the letter K. That's why it's called a K-shaped recovery. Although it doesn't always look this perfect. That's why you have to find one that is fake. All right, so let's take a look and see what our K-shaped recovery was. This is a comparison of the S&P 500 and unemployment rates. And what happened is right when the pandemic hit, 2 things happened. One, the stock market just dove. And number 2, unemployment, people got laid off by, the millions. And so the unemployment rate went all the way up to 14.7 by April. And I remember like every day was like tens of thousands of layoffs. So the unemployment rate, it took until December of 2021 before that returned to normal. But by June of 2020, just after 3 months, the people that had their money invested in the stock market were already breaking even and ended up coming out ahead. This is a K-shaped recovery because you have the people that are unemployed versus the people that had money in the stock market. One is going to make a lot more money than the people that aren't making any money at all. So that's what a K-shaped recovery looks like. It's when one segment of the population ends up recovering faster than another segment. But I want to make this sound like it's something brand new. This is a trend that's been going on since 1980. As you can see here, the green bar is the top 20%, and the red bar is the bottom 80%. And just go through some of the key insights here. The top 20% grew 124% between 1980 and 1925. The top 20% grew 124%, while the bottom 80% just grew 15%. And from 2035, the top 20% will grow another 31%, while the bottom 80% declines 3%. This gap widens from 3 times in 1980 to 7.8 by 2035. So we are increasing wealth inequality in this country for the last 45 years, but we're accelerating that rate for the next 10 years. So it's not saying that the problem started with Trump, but they are certainly being exacerbated by Trump and his policies. And we're going to go into that. And I'm not just talking, I'm going to show you, but you got to do these things in a certain order. The second thing is I wanted to look at the bottom 20% versus the top 20%. Because the bottom 20%, if you notice, this line is almost flat. The bottom 20% and 20 and it's actually going to start going down. I'm just going to point this out to you. Like in 2025, the bottom 20% is making 15,600, and in 1980 they were making 12,500. So they've made 3,100 more over the last 45 years. It's gone up. But it gets better from there because it's going to start going down. By 2027, they're going to make 13,572, which is only $1,000 more than they were making in 1980. The bottom 20% in 2027 will be down 13%, even from 2025 in just 2 years, and the bottom 20% in 2030 will be down 19% from 2025, compared to Great Depression losses. So 2035, look over here, 14,040 over here, 12,500. So that's only a difference of $1,500 over 55 years versus over here 142,400 and 416,000. So there's a big difference. These people in 1 year will see more gains than these people make an entire year. These people will increase by what they make due to Trump's policies. So here's what we call the income inequality ratio. And you take the top 20% and you divide that by the bottom 80%. And that means that, in 1980, the top 20% were making 3 times what the bottom 80% were making. By 2035, they're going to be making almost 8 times what the bottom 20% are making. So this is not that the bottom 20% or the bottom 80% even are feeling like the economy is not working for them. The economy is actually not working for them. So let's look at what we're talking about with these quintiles and how much money that means. The bottom 20% right now are making 15,600. The second quintile is 38,400. The next quintile is 67,000. So 60% of the country is making 60,000 or less. Then you got the fourth quintile is 105,000. And then finally, the top 20% is making 318,000. This is not a healthy economy. I think that, it being staggered is fine. I don't believe that there should be an equal slice of the pie, but I think everybody should get at least a bite of the pie. So now let's look at how Trump's policies impact each of these groups. The bottom 20%, who was already making only 15,600, are going to see a change of negative 10%. These people are going to see a change of negative 5%. These people are going to see a change of negative 3%. So that means over half the country, well over the half the country, is going to see a net loss of income over the next 10 years. But the fourth, there's no bar there because they're zero. And then finally, you've got the top 20%. They're going to make money. They're increasing 31%. But even that, we're going to have to come back to this in a bit. Even this is a little bit deceptive. This is This is unprecedented, the first time in modern history we're implementing policies that deliberately redistribute from poor to rich during economic strength, not crisis. And that's something the economy was actually not doing badly. As much as Donald Trump would like you to believe that, the economy was not doing badly. All of the things that are going to make it do worse are self-sabotage, especially the tariffs. The tariffs hit bottom 80. They hit the bottom 80% 2.5 times harder than the top 20%. The tax cuts, the top 10% gain $12,000 a year. The bottom 10% gain nothing. And they also lose things like some of their SNAP benefits or their Medicaid benefit cuts. But bottom 10% lose actually $1,600 a year. The top 20% are unaffected. And combined effect, the largest upward redistribution of wealth in American history. Because by Jove, the rich people just don't have enough money. How is Elon Musk ever going to get butter on his bread if we're not starving children to death? Every previous period of comparable inequality, the 1890s Gilded Age and the 1920s, ended in either major progressive reforms, like the Progressive Era and the New Deal, or economic collapse, like the Great Depression, or both, like the 1920s. We are headed for a major recession because of the way that the K-shaped economy is going and has been going for a number of years. Okay? So, now let's talk a little bit about what some of these numbers are, or what some of these terms are. The GDP is consumption plus investment plus government spending plus net exports. And net exports is more of it's not really a factor like you think it is. It's not like we're supposed to be making more money on exports than we are on imports. It's more of a calibration of what are we actually selling to our own citizens. The consumption is how much money do consumers spend, and investment is how much money is spent on new investments. And for this, want to clarify, it's only new investments. So if you build a new building and put office chairs in it, that's a new investment. But if you're just buying a new office chair for your home office, that is consumption. It depends on, is this a new business or is this an existing business? The G stands for government, and that's all the government spending, and that includes everything from what the federal government spends to what your your local library. It's federal government, state government, city government, all of that. And then next, net exports is just your imports minus, or your exports minus your imports. So you add all those numbers together, you get the GDP. And then you take the then you figure out whether it's going up or down by a percentage. When you one thing we're going to do here is we're going to look at some of these numbers, especially the consumption and investments, and show how those are actually misrepresenting what is not a healthy economy as a healthy economy. All right. So got some more charts for you to explain those things. But before we do that, I'm going to need to explain some like more about okay, next up, let's talk about how Trump's policies are affecting the economy. The first thing, and also like who they are affecting. So the tariffs are the biggest thing, and the thing about tariffs is people are saying, oh, those are a tax on the people and stuff, but they're not just a tax on the people; they're a regressive tax on the people. And there's some different things about that, like the for instance, we talk about the auto industry is trying to eat some of the tariffs. Well, the auto industry is something you're not going out and buying a new car if you're barely able to put meat on the table. The new car buying is something that only the top 20% is almost worried about, not the bottom 20%, if you follow me. So the auto industry eating some of the tariffs doesn't help the person that is at the grocery store trying to buy coffee, which is up 22%. So the other part of that is the poorer you are, the more of your money you spend on essential items. And if those essential items are going up in price, it means that you're spending a higher percent of your income on tariffs, which makes it essentially a regressive tax. And so this chart here shows what I mean by that. The bottom 20% are paying 6.2% of their income in tariffs. The next 20% are spending 5.5%. The next 20% are paying 5%. The fourth 20% are paying 4.2%. The top 20% are only spending 2.8%. And the top 1% are only paying 1.7% of their income on tariffs. So the more money you make, the less the tariffs hurt you. The less money you make, the more the tariffs hurt you. The tariffs are hitting, I'm sorry, tariffs are hitting the poor 3.6 times harder than the top 1%. And the average cost for middle class families, the ones that are right in here, is about $3,800 per year. So now the spending cuts. That's the next policy of Trump's, that the big Build Back Better, or I'm sorry, the Big Beautiful Bill thing, whatever, I forget what it's called now. But the Medicaid and SNAP cuts are costing the poor 7.4% of their income. And you might want to say, well, that's not income, those are government handout. Doesn't matter. Doesn't matter what you call it. If you don't have a SNAP card to pay food, then that food has to come out of your wallet, and you don't have the money there. They're actually have less money. So then the second 20%, they're losing 2.9%, because the way that our benefits are structured is to, uh, what we call entitlement spending, is to help people that need help first. So the second 20% is 2.9%. The middle, they lose 1.8%. The fourth quintile only loses 0.9%. And finally, the top quintile loses 0.3%. So 7.4% is the lowest quintile, loses this share of income by 2033. Okay, so all right, so this is by 2033, these numbers. And then over the 10 years, they're cutting spending. That means they're cutting benefits. Just want to say, oh, they're cutting spending. They're cutting benefits, and they're cutting benefits to American citizens. They're not cutting benefits to undocumented workers or whatever kind of crazy talk that they want to tell you. These are American citizens and or people that are working here legally. And the bottom quintile is hit 25 times harder than the top. Okay, now let's move on to mass deportations. All right, because that's supposed to be really helpful to the economy, right? We're going to get all those jobs back. And to be fair, the low skilled authorized workers that are working in those industries, like the guy that mows my lawn, he's going to get a little bit more money because there's just going to be more work for him. And his prices aren't going to be undercut as much. So he might make a little bit more money. But all the benefits he loses offsets that. The middle income person is going to lose about 8% or 0.8% of their income. Not going to be too much impacted either way, but they will lose a little bit of money. And that's because not everybody is like undocumented workers add to our economy. They actually help our economy. Nobody wants to talk about that. The highest skilled, they're going to lose 2.8% of their money. And the farmers in rural areas, that means like the farmers and people that work in farm-based communities, like the feed stores and the hardware stores and all the people that keep the farmers in business. When those farmers start going out of business, they're going to start going out of business. So the rural American towns that are in these farming communities, they're actually going to be hit really hard. They're going to lose 16% of their income. And then you've got your mixed family status where like you might have a husband and wife with kids, and the husband's here legally and the mom's not, and so he gets deported and the mom is stuck trying to raise the kids by herself because those kids don't deserve to grow up with a father, I guess. Anyway, they're going to lose about 63% of their income. So then we kind of talk about the ACA changes. And this is obviously not everybody is on ACA. All right. So, but those that are, your premiums are going to go up. And so if you're making 28 grand a year, and right now you're probably paying about $27 a month for your ACA. Well, that's about to go up to $130 a year. And if you're an individual age 60, you're currently paying $25 a month. Well, you're going to start paying $800 to $900 a month. Not old enough for Medicaid. What about the couple age 60 that's making $85K? Well, theirs is going to go up $2,300 a month. And the family of four, right now you're paying $400 a month or $146 a month. You're about to start making $411 a month. So a lot of these are people that right now they're not paying a lot, and they're not paying a lot because they can't pay a lot. The whole point of the ACA was there's people that are making too much for Medicaid, but not enough to afford their insurance. So the ACA is to help them be able to afford it. Well, there was no magic wand waved. They're not going to be able to afford it. So a lot of these people are going to just not be able to have it anymore. And the few that are going to have to do things like, maybe they have a car they're going to have to get rid of, or a car that they're not going to be able to buy, which that's going to take money out of the economy. But the point is, whether you're on the ACA or not, this is still going to affect you, because all the rates are going to go up to offset this, because people are going to not have insurance and they're going to go to the emergency room. They're not going to be able to pay for their medical bills. So then that money is going to get passed on to people that have insurance. And you might have private insurance, and you might have insurance through your your employer. But even if you have insurance through your employer, their rates are going to go up. And if their rates are going to go up, that means your pay increase may not be what you thought it was. Your Christmas bonus may not be what you thought it was. Everyone's going to end up having to bear some financial burden if we don't do this. This actually saves America money. And there's about 4 million people who will lose their coverage as a result of this by 2026. All right, so now let's look at this is the cumulative effect of, oh wait, of all of these policies, right? The bottom 20% are going to lose 17.1%. The second 20%, 13.1%. The middle 20%, 10.6%. The fourth, 7.6%. And the top is also going to lose 6.4% of their income. So who's making money? The top 1%. When tax cuts are included, only households earning over $915,000 see net gains. So 99% of the people in this country are going to lose money because of Donald Trump's policies. I don't care who you are. If the leopard thinks you have an edible face. All right, so now let's talk about the inflation reality. Inflation is at 2.9%, and we act like inflation is just this static thing, right? But some things go up, some prices go down. And we have different kinds of spending that some is essential and some is not essential. It's discretionary. For instance, food that you eat at home is essential. Food that you eat out is not essential. Even like gas is not an essential item, it's a discretionary item. For some people, perhaps in like rural areas where there's not a bus, gasoline is not essential. But a lot of the gas money you spend is discretionary driving too, right? Like if you want to go out on a drive, or you want to take a road trip or whatever, gasoline is not essential. You don't need gasoline to live, so it's not essential. Airline fares are not essential. New clothes are not essential. A new car is not essential. Coffee for some people is essential, but food is essential. Utility gas, like keeping your house heated, is essential. Car insurance, if you have a car, is essential. So you've got things that are going up and things that are going down, but the things that are going up tend to be essential, and the things that are going down tend to be discretionary. And when your income's already gone and things get tighter and tighter, more and more of your money ends up being about these essential things and less about the non-essentials. So what's happening right now is there is a regressive impact. Lower income households spend a larger share of their budget on essential like food, utilities, insurance, the very items rising the fastest. And the average misleads because it's making all of this go together. And the people that spend the least amount of their money on essentials are the wealthiest. So this is like a little graph that shows what percent of everybody's money is essential versus semi-discretionary versus discretionary. And as you can see, here the red gets smaller and smaller and smaller, and here the green gets bigger and bigger and bigger. So wealthy people are actually experiencing less inflation, like literally less inflation than poor people. The poorest 20% spend 85.5% of their budget on essentials that are rising 6 to 21%. The richest 20% spend only 58% essentials and 24% on discretionary items like travel, entertainment that are actually falling in price. When politicians say inflation is only 2.9%, they're averaging into what the poor must pay with items wealthy choose to buy. And so that's why they are having different realities. The things you need to buy are going up. The things you don't need to buy aren't going down. But you're not able to buy those things if the things you need to buy are taking all your money. Okay? So there's more to this as well. And that's where I want to talk about how do poor people pay for things? They're losing money, right? They're losing this money. But how do they pay for it? Like the prices are going up and their income is going down and they already didn't have enough money. So what do? You pull out the plastic. And right now we have a serious credit card problem and a serious uh, personal debt problem. That is actually, we talk a lot about the national debt. That's a problem. I'm not saying it's not. That's a problem for the long term. We have a short term, urgent, acute credit card problem that has gotten a lot worse since the pandemic. And I'm not saying that this is a problem that started with Trump, but it's another one that he's pouring gasoline instead of water on the fire. So right now we have a total of $1.21 trillion in total credit card debt as a nation. That's up 57% since 2021. And not only that, the average APR on balances is up to 22.83%, up from 16% in 2020. So people are not just having more debt and carrying more debt, they're paying a higher interest on that debt. And 40% are carrying credit card balance, and 60% of those are carrying them for up to for over a year. And so when you're talking about this 22.83%, people are spending money on debt. They're spending money they don't have on debt, and they're spending that money on debt because they don't have the money to buy their meat. So it's this cycle. They have to buy food, so they put it on credit. And now we're coming into being a society where if you're not in the top 20%, or at least in the top 60%, you basically are so far in debt that you may never get out. The explosive growth of credit card debt. So this quarter 2021, the total credit card debt was $770 billion. Now it is up to $1.2 trillion. So that's over $500 billion in credit card debt added in just 4 years. And like I said, I am not trying to put all of this on Trump. And it didn't, it was already, 770 billion by the time that Biden took office. So it's not like it started then either. But he's making it worse by this craziness with all his policies. Okay. The divergent: spending up, debt service up more. Okay, so real consumer spending versus debt service burden. Debt service burden means the percent, or debt service includes the cost of your interest rates and your annual fees and all of that kind of stuff. All of the money that you give to your credit card company or your bank or whatever, that's what the debt service is. And so this right here, this red line is what percent of the average American's income is going towards just paying their credit card. Right now, the average American is spending 172.2% of their income because of credit, and 8.2% of that money of their income is just going to not paying down the debt, not the minimum payment. That's just the interest and fees and all that kind of stuff that go with having the credit card. So that's another chunk of money people don't have, and it's getting worse. It's getting worse. It got worse under Biden. I'm not saying it didn't. And I'm not saying it's Biden's fault either. I'm just, sometimes we get too much into this, correlation equals causation. There's a lot more behind this, which we'll get into some of what's going on that is making this. But what I'm trying to establish here is people are spending more money on credit cards because they have to. And so there really is a different America for people that have money and people that are struggling. People that a good chunk of America, most of America right now is in a severe recession. But the numbers are masking it. When you look at this, when you look at people are spending 107.2% of their income on a monthly basis, that means they do not have enough income. And it just means that they're going to keep going further into debt and then paying a higher percentage of that debt. And then that higher percentage of that debt is going to mean that they have to borrow more money the next month. Then there's the savings collapse, from safety net to debt spiral. So these are, some people used to have savings. Well, they ran out. And so now they have to do this, and their credits are going up. So the green line here is how much money people had saved. The savings rate, it's gone from 16.8% in 2020, when, by the way, Trump was president in 2020. I think a lot of people forget that. I always want to talk about Biden was president. No. So it took the first part of the pandemic, took a lot of savings. Then when inflation hit in 2022, it took another hit. It started to stabilize along with the interest rates, but now it's starting to go back up with the tariffs and how that's causing everything. So the K-shaped credit economy. The top 20%, they 12%. Okay. They pay their full balance off. This is, the red is percent reliant on credit for daily expenses. So most of the top 20% don't need to borrow money to, survive. The bottom 20%, 68% need to spend money with credit in order to survive. All right. And then you've got the top 20%, 75% pay off their balance every month. And the bottom 20%, only 25% do. And that's pretty meaningful, because that means for a lot of people, if they're making 2% or 5% cash back, their credit cards are an investment. They're actually making money off of their credit cards, whereas these people are losing money off of their credit cards. And these people have money, and these people don't have money. So the these are the consumer health warning signs. The APR being 22.83%. The percent carrying their balance over a year, it means they're just paying the minimum, which means that they're going further into debt. The delinquency rate is 6.93%. Savings rate, they only 3.9% have savings, and they're like worried about it. So how much of so this is where I want to talk about what is GDP, and why does it matter that we're talking about how people are spending money. So the way that you get GDP, the way you calculate it, is GDP equals consumption plus investment plus government plus net exports. Net exports is really just kind of a calibration to balance out, where we're selling, like what is really like being consumed in America versus consumed overseas. So it's not like, Trump thinks it's like some sort of sign of success, or like if you're like net exports needs to be plus, or he doesn't understand. For somebody that's supposed to have went into Wharton, he doesn't seem to have much grasp at all of any of the basic economic principles. Anyway, net exports is not a sign of success. Like, it's not you want to have a plus net exports. It's just a calibration of consumption and investment. Consumption means that is how much money consumers spend. Investment means money that is spent on new business, or new businesses. So if you're upgrading an existing business, that would not be investment. What be investment is starting a new business. Government, or the G is for government. That's how much money the government spends. And that's not just the federal government. That includes the federal government, the state government, county government, city government, whatever, school boards, libraries, all of that kind of stuff is considered part of government. And you add those four things up, and that is your GDP. The biggest part of that is consumption. But if a significant chunk of that consumption is credit card based, then that means that consumption number is not telling you the whole truth. So, how much GDP is credit fueled? Share of GDP and estimated credit financed portion. The consumer spending is 67.7%. 18% of that is just credit cards. So it's not really a sign of how strong the economy is. It's actually a sign, like, that's about what, 18 divided, I guess, hang on. You're talking about 26, 27% of our consumer spending is borrowed money. So that means that the consumption in our GDP is somewhat being propped up by credit cards, if you follow me. It's not really a sign that our economy is doing that strong. It's a sign people are borrowing a lot of money to survive. Okay, so then what about the next thing is, and we're going to look at this a lot later, but the AI in the data centers. 4% of our GDP comes into the investment, and this is all the investment category, but 4% is just AI and AI centers. But none of that is credit card finance. The 18% of all our business investments, of which this 4 comes out of that, is so 18% of our GDP is there, and then 5% of that is credit finance, not credit card, but credit finance. So we're borrowing that money. And then there's the government, and then there's the net exports, which right now are actually down, but that's the way. That doesn't mean bad. Okay. So what does this mean? It means that a big chunk of what our GDP is just credit. It's not real. So that's another reason that people aren't feeling like the economy is going gangbusters, because they have to spend just in order to get month to month. They keep going further and further into debt, and they end up having to pay more and more money the next month to pay off their debt, to pay for their debt, which means they have to borrow more money than they did the previous month. It's a snowball effect. They're not just feeling that they're in a recession. They are in a recession. Let's talk more about this regressive debt crisis. And we're going to look at this. I started to, as I was going into this, sometimes I get to rabbit holes, and I was thinking, is this a bigger issue than the debt? So the national debt versus credit card debt. So the rich use credit cards for rewards, pay in full, earn cash back, pay 0 interest. The poor use credit cards for groceries and gas, can't pay in full, pay 28.5% interest, spiral into debt. It's a poverty trap disguised as access to credit. And then it's just used to prop up the GDP. If the poor people didn't have credit card debt, they wouldn't have food, and the GDP we wouldn't be hiding the fact we're in a recession. So this chart shows the average balance of people by so the blue is your average balance, right? Of course, you can have a higher balance if you make a lot more money. So the red bars are the percent of income that your debt holds, right? So people under 50,000, they have 14% of their income. They have an average balance of $4,200, but that's 14% of their income. Then if you make 50 to 80, you've got 10%. If you make 80 to 100, it's 8.6%. And if you're over 100K, you're making about 5.8% of your income is in credit card debt. So once again, you're talking about things that the more money you make, the less it hurts you. And so then what happens is when you start getting to the point where you have borrowed all the money you can and you can't pay off anymore because you can't borrow any more money to pay off your debt, then what starts happening is people start going into delinquency. And so in the third quarter of 2022, the green here is like highest income zip codes, and The red is lowest income zip codes. So these represent people that haves, and these represent the have-nots, right? And so you can see that these the delinquency went up a little bit. You know, it went from 4.8 to 8.3, but here it went from 14.9 to 22.8. So everybody's starting to experience, you know, the issues here, but the less money you make, the higher the worse it is. We've got, I mean, you think about that, like one almost 1 in 4 people in the bottom 20% are not able to pay off their credit cards right now. And then the next thing, why are they borrowing? You know, groceries, utilities. Those are, you know, like the poor people, the ones in the red, they're borrowing for things like groceries, utilities, gas, emergency expenses. These guys are buying for luxury items and then paying off their debt at the end of the month. So they're just getting a discount on their boat or whatever. Poor households use credit cards for groceries, 45%, utilities, 38%, and gas, 42%, basic necessities. Rich households use it for luxury items while paying it off in full each month. The APR trap, the poor pay more, and that's the other thing. The lower you, the less money you make, the lower your credit score is, and so the higher interest you have to pay. So they're paying 28.5%. The people with the good credit, because they can pay off everything at the end of every month, are only paying 15.9%. So the less money you make, the more money it costs you to borrow it. So this is like the what I call a reverse Robin Hood effect. Poorest households with low credit scores pay. So those who need the credit the most pay the most for it, which is why they're charged the most for it, because they need it the most. And so this one right here, this is how long it takes on average people to pay off debt. If they're making under 50K, they end up paying, it takes about 84 months to pay off their debt, and they end up paying 7,800% in interest. So 78 times what they borrowed. These guys pay it off in 18 months. Or not 7.8 times what they paid. I'm sorry. So these guys are paying almost 8 times as much back. And these guys are paying like maybe less, maybe double. Which amplifies, you know, that you shouldn't be using credit cards if you can. But it's easier to, you know, than some of these people might be, you know, started off here and got promoted or something too. So, all right, the payment divide. Percent of people who pay balance in full each month versus percent who carry balances. I'm just going to go with the top and the bottom here. Under 50K, 56% carry balances and 25% pay in full. Here you've got 30%, 34% carrying balances and 75% paying in full. So they're making money off their credit cards, and these guys are losing money off of their credit cards. This just goes into the whole, the rich get richer thing. All of these things, the rich get richer. The rich aren't worried about the economy right now because the economy to them is not a recession, but the poor are in a recession. This is not about, you know, oh, the poor people feel like they're in a recession. The poor people are in a recession. It's not a vibe, it's a reality. So now I think I'm gonna skip that one after all. Now let's talk about why. Why is all this happening? Why not why is this happening? Why is there this confusion over where the economy is really at? And this is where something, things get, well, hopefully things have been interesting, but they get even more interesting. Okay. A lot of it has to do with AI. And one of my favorite quotes is that right now the US economy is 3 AI data centers in a trench coat. If you can, like think of the cartoon where they like all stand on each other's shoulders and they wear the trench coat and they disguise themselves. Well, that's what's happening right now. The AI is disguised as the economy, and it's not the real economy. It's a fake economy. This is the first half of this year what contributed to GDP growth. AI investment was one point, I think it was 3% for the first half of 2025, right? AI contributions were 1.1%, consumer spending was 0.9%, and then government net exports is 0.2%, and then other investments was minus 0.2%. So that's interesting, right? AI 1.1, other investments minus 0.2. This is where things get interesting. AI share of total GDP growth. All right. This is how much of the GDP is growing because of AI. And again, this did not start under Trump. It started under Biden. Well, maybe under Trump the first time, but it has nothing to do with either president, so it doesn't much matter. It has to do with advancements in technology and really doesn't have anything to do with either one of them. I looked into whether or not the CHIPS Act had affected it, and the CHIPS Act doesn't really have any impact on it. The AI data, the AI boom is entirely a matter of the private sphere. So the AI share of growth was 18% in the third quarter of 2024. It was 25% in the fourth quarter of 2024. It was 40% in the first quarter of 2025. And it's 92% in the first half of 2025. 92% of growth is all about AI. So what does that tell you? That tells you that outside of AI, maybe the economy is not going as gangbusters as you think. So it's like it's not just a K-shaped economy. You can say it's a special K-shaped economy because it's not just rich people that are doing well. It's rich people in the AI sector that are doing well. So this is, if you want to take it another approach to it, this is what GDP growth was if you factor in AI. But if you took AI out of it, we would actually have shrunk as an economy. And this is important because AI is not like a major employer and it's not making any revenue. This is just all investment. That's all it is right now. Is it's just everybody's throwing money at AI hoping that they're going to be in the ground floor of the next Google or whatever. Like the AI is the future, and if you get in now, if you get in on the ground floor, you'll own a piece of the future. Right now, mostly what AI is just investment. There has not been a return on it. None of the major AI businesses are even remotely close to turning a profit. So how is this money getting invested? 41% of it is in computers and equipment, 30% in data centers, 12% in software, and then minus 3% in other stuff. So this spending has actually gone down. Okay, and then this is how much money has been cumulative. In the first quarter was $72 billion, and then in the second quarter was $69 billion. I looked into it. This does not look like it's the start of a trend, but basically, investment in AI has been going up. Everybody wants in on this, and if you look at the information processing equipment is 92%. Other sectors, all the rest of the technological sectors outside of AI, and all the rest of manufacturing and everything else combined is actually gone down. And then 15% of our growth is from consumer spending. So the irony is that manufacturing has gone down, not up, but it's being masked by the it's being masked by the explosion in AI. Right. So now let's look at the next thing, which is what I call uh, the AI cycle. Or there's reasons that people want to invest in AI, but there's also reasons people don't want to invest in other things. So there's this kind of tariff uncertainty that's creating a dangerous backfeed loop. And what happens is, first, tariff uncertainty freezes investment. So you've got nobody wants to invest in manufacturing right now because they don't know what kind of tariff Trump is going to impose on something the next day, because that could change everything. You could have spent too much money on it. You could have spent money on it, and now it's just wasted because your business became unviable because Donald Trump decided you have to pay twice as much to import iron as you did yesterday. And then 30 days from now, it could be, you find some sucker to sell your business to, and then he changes his mind again. So right now, people don't want to invest in anything like manufacturing because it's so uncertain. We're losing, like, we're we're not investing in manufacturing right now. The number one place that investments have gone down is manufacturing. Everybody keeps saying, oh, well, we're going to bring back manufacturing. No, what you're doing is you're pushing away manufacturing. So then, okay, we don't want to invest in this, but we want to invest in something. So capital seeks safe alternatives. And what's the one safe alternative there is right now? AI. So it's a double-edged sword. On one hand, there's this appeal to AI. And then secondly, there's a lack of appeal into anything else because Donald Trump just doesn't know how tariffs work and refuses to learn. So the tariff freeze is actually driving up AI investment. So that sounds like, well, as long as, what's wrong with investing in AI or whatever, there's something called opportunity costs. And so what that means is if you're investing money in AI, that means you're not investing money in manufacturing. And that means those manufacturing jobs aren't there. That means that the things that you would be selling if you were manufacturing aren't being sold. That means that consumption isn't getting consumed. You know what I'm saying? Like, everything else ends up losing because of AI. And we're going to get more into that. That's even worse than it sounds. But right now, we're just kind of walking through this one step at a time. Consumer demand weakens because it's not just that, the new doodads aren't for sale. Nobody's improving doodads because nobody's investing in doodads. So you've got the same doodads that were there 5 years ago versus other places, their doodads are getting better. So now we have to buy doodads from elsewhere in order to get the best doodads. And so we lose that job creation for the doodads. We lose the and we also lose uh the improvement of doodads. So that makes AI look even better because you can't even keep up with the doodad market anymore. So eventually what you have is you have this kind of economy where all our eggs are in the AI basket. And you've got a geriatric octogenarian with terrible bowel control juggling these eggs. And that cannot survive long. So the economy becomes fragile. And eventually it's going to break. Eventually Donald Trump is going to drop eggs. And it's going to be really, really bad. What happens if tariffs change again? What happens if AI doesn't deliver and the bubble pops? What happens if consumer demand drops? Another thing is, if all our expendable income is getting disappeared through higher investment or higher credit card debt and higher insurance premiums and higher prices at the grocery store, at what point do you have to pay for these subscription services to AI companies? Like, so you could actually end up hurting AI by doing this. So then let's go to the investment shift. This is what is actually happening. This is not hypothetical. So this is AI right here, and this is manufacturing and consumer goods, right? And so you want to have all of these things being spent money on, but actually manufacturing and consumer goods. Remember how I told you I wasn't making up the thing about manufacturing? Manufacturing went from 145 billion to 92 billion in the last few years. It's gone down from 110 billion to 92 billion. $18 billion loss in manufacturing investment since Donald Trump took office. You know what hasn't gone down? AI infrastructure. So manufacturing has declined by 37% since 2020. It's gone down 29. Consumer goods have gone down 29%. AI has gone up by 1,171%. Because it's the only thing safe right now, and it's not that safe. So then you've got uncertainty. Okay. This is the uncertainty index. Anything over 80 is high. And this is like, or I'm sorry. Yeah. So this is the blue line here is AI investment. And this right here is the orange line is the uncertainty index. So what this means is as this goes up, this started off at 35. The higher this goes, this is just proves what I was saying. The more money AI investment is. People that don't want to, that are uncertain about their investment or are scared of investing in the manufacturing and consumer goods, they're just putting their money into AI. So we're just building up and propping up AI more and more, even though not one company I'm aware of is actually turning a profit yet. So there's this thing called opportunity cost. And what that means is money you're investing somewhere else is not being invested there. So you've got manufacturing capacity. We've basically not invested $215 billion in manufacturing since 2020. It's gone down, and it started under Trump, and it's still happening under Trump, and it happened under Biden. I'm not playing all the blame on either one of them, but we're not building these things. We're not investing in consumer product innovation or traditional research and development. And that's on top with Trump now. He's exacerbating that too by cutting funding for universities and research in universities. And that's not just a momentary thing, that's a generational thing. The US has thrived because we've always been at the forefront. But now we're at the back of the line. We're not investing in research and development anymore. So the next big thing that comes out, well, the reason we're doing so well in AI is we invented the chips. Well, what happens if somebody else starts inventing better chips than NVIDIA? Small business investment is going down, and infrastructure is going down. This means that we have less domestic production, means we have fewer products to buy, which means consumption goes down, means we have reduced R&D, which means we don't make the same improvements, which means we can't keep up internationally. It also means like your next car might not have the features you want. The appliances that you're getting, no more improvements on your freezer, or your fridge. It means that new housing construction lags behind. We have a housing crisis. All of this means that real day-to-day life is getting worse for the average American. And it means that we've lost about $768 billion. Okay. There's also risks because we're putting everything into AI. Okay. This risk score, this is most of the stuff I've numbers are coming from like Moody or Yale or Wharton. This number right here, as I did use, ironically, Claude to research this, and these are like a risk factor that Claude came up with based on those different kinds of numbers. So if you don't want to believe these numbers, you don't have to, but I think they are based in fact. But there's a risk of 88 for overconcentration in AI. Like when you're putting all your eggs in one basket, it just makes sense. Manufacturing investment decline, 82%. Tariff policy uncertainty, 85%. Consumer goods innovation gap, and supply chain vulnerability, which is another thing we haven't even talked about yet. But when you have these tariffs and everything, and you start affecting supply chains, then you could just end up have devastating impact on an industry just by because some component of it, like a little screw or something that is you're getting from the Philippines, you got this one part from the Philippines that all of a sudden you can't get anymore. And so then your whole system becomes, moot. All right. So let's talk about the market. If everything is so bad, why is the market doing so well? And what if I told you it's not actually doing that well outside of AI? So we got 3 lines here, right? And so what happened is the economy was doing pretty good. The market was doing pretty good when he took office and kept doing a little bit better. And then he said trade war, and it took a plunge, right? And the then he said, okay, so then Trump chickened out, and then it started going back up, right? But here's the thing: is you've got these three things: S&P 500 overall, which is the blue line, and then you've got the green line, which is just the Magnificent Seven, the AI stocks, and then you've got the orange lines, which is the ones everybody else. Okay, so this is going back to that whole average median thing. AI is way up here. Everybody that's not AI has still not recovered. Outside of AI, outside of those 7 AI industries or firms, the stock market is still not recovered from the trade war. The AI stock market is actually holding up the entire stock market and propping it up. So when people say, what about the stock market? Stock market's not doing that great. AI is doing great. Okay, so what about jobs? Let's take a look at jobs. Well, this was also a thing that I wanted to look at, and I found it was interesting. Okay, first of all, is the unemployment rate really better or not? Is it, you know, what is the actual unemployment rate? Well, there's always these different things that go around, but if you add if you add up who is actually unemployed and looking for a job and qualifies for unemployment, and you add people that just are discouraged and stopped looking, and people that are, like working in jobs that they barely are attached to, or like they're involuntary part-time workers. You're talking about like Uber drivers, or people that are just trying to do gig work until they find a job, or they've just said screw it and they're just not even in the labor force anymore. So like none of the people that are currently, either they're not working at all, they're not looking for work, they're looking for work and not finding it, they're doing gig work until they can find work, but none of them actually have like what they would call jobs. All right. You add all that together. In the fourth quarter of 2024, it was 9.7%, and now it's 10.6%. Or in the first quarter of 24. And so, and then when Trump took office, it was 10.2%. Now it's 10.6%. And this is not to blame Trump or Biden. I'm just pointing out these are just what the reality is. There are a lot more than we recognize people that are unemployed. 4.3% are actually unemployed, and then U6 are discouraged and marginally attached. That rate is 7.6%. And then if you add them all together, it's 10.6%. And then this is the labor force participation rate, which this is what percent of the ideal working population is actually working. And that percent has dropped 14.1% since pre-pandemic levels. So there's a lot of people that are still not working that were working. And some of them, there are definitely people that were just like, I'm done. They're 60 years old or they're 50 years old and they have enough money and they retire. And so not everybody that's left the workforce did so because they didn't have money, but some people did. Or, and they've just completely given up. Okay. So, and those aren't accounted. And so this is this is the labor force participation rate. This right here, the blue line is the participation rate. And then this right here is the prime age for for employment, and that's 82.9%, right? So this number has not changed that much, but this number has dropped pretty significantly. Now, the next thing I wanted to look at is, why have we had these massive changes both under Biden and under Trump, like these massive corrections in jobs reports? And is it because people were lying or what? Um, yeah. One reason is that since the pandemic, new businesses have launched, but they haven't. They either haven't lasted as long, or they haven't been able to hire as many employees as they used to, or as you would expect. So there's I don't. Think this must be thousands. So anyway, what this red line going down means is that the businesses aren't lasting longer, and what the green line going up means is that there are more businesses. So all these new businesses, there's something called the birth death rate in determining the jobs report, in estimating how many jobs are created. But what happens is, when these businesses aren't recreating as many jobs as you expect, and they last less time, that means like that the number you're think so what happens is, these numbers, so there's something called birth death rates when they're trying to calculate the number of jobs created. And that means, like, the if a new job if a new business is created, you expect this many jobs to be created from that new business. And if that new business uh and if a business goes under, you expect there to be a certain number of jobs lost. What happened is, since the pandemic, you've been getting a lot more new businesses, but they haven't been hiring as many people, and they haven't been staying in business as long. So what happens is that you get this illusion that there are more jobs being created that they are, and um, you're not accounting for all the jobs that are lost. And it's not like this is deliberate. There's models that have used certain algorithms and whatnot before, but those have gotten outdated. Like, they're no longer effective, because the whole hiring, the whole starting new businesses and them going under, the parameters have changed so much that the estimates are no longer working. So then, when you get into the actual numbers versus estimated numbers, you start weighing in on the difference. All right. So this also has a lot to do with AIs, believe it or not, because a lot of these businesses are the AI businesses. Because remember, we just covered 93% of these new businesses are AI. So these businesses are AI. And so one thing that happens is that, these AI businesses are not hiring as many people because a lot of these entry level jobs that you would be hiring for are being done by AI since they are AI businesses, right? So the new AI businesses aren't hiring as many people as a model might suggest would they should, and then they're going under fairly quickly because there's so much competition and all of that, and it's like all about venture capital and there's not a lot of income coming. So if you're not getting venture capital, you're not you're not staying in business. So the few people that are hired end up losing their jobs anyway. So you end up with this illusion that all this money being thrown into AI is creating all of these jobs, but it's not actually creating as many jobs. And again, this is not Biden, this is not Trump, this is AI, and it's not intentional. It's just a change that the model hasn't caught up with. So what happens is you get like the AI hype. There's, it started there. You got to get into AI and, AI this and AI that. And, for the last 5 years, it's been a big drive in the economy. And so then the venture capital starts flooding in and creates, so many jobs. And then the startups form up, and that's like even more jobs. And then the model estimates start coming, then the model estimates here are not actual, they're not AI model estimates, they're the model estimates for birth and death rates for businesses for figuring out new jobs. And so they're predicting it's going to be, 85% versus 50%. So there's more jobs being estimated than there are actually being generated. Then a few months later, those jobs fail. So a lot of these jobs that you thought were there are no longer there a year later. And so then when the reality check comes in, you're like, oh, we're nowhere near there. All right. So you follow me? There's nobody lying. It's just the reality hasn't caught up to the models yet. So they need to figure out how to adjust the models. It's just nothing like AI has ever happened before, to where all the new jobs are built on the predicate that you don't need people to do jobs. Like the whole point of businesses and everything before, like that's where you got jobs. Well, now AI is not hiring as many jobs. They're not making any revenue. And so because they're not making revenue, they're going under, and these jobs that nobody ever had and the business doesn't even exist anymore are lost. So I found this really interesting to show that it's not about a president and it's not about lying. It's about the projection from the birth death model assessment. This is how many jobs were estimated versus how many jobs were created over the last couple of years. And as you can see, this number keeps going up. The blue keeps going up, and the red almost proportionally goes down, right? So here in the fourth quarter of 2025, you've got the birth death model estimate like almost 2.5 times actual jobs created. That's not anything to do with anybody that is trying to frame Trump or frame Biden or whatever. It's just there just weren't as many jobs created because the model had not caught up. But what that does mean is that all of this is saying unemployment is not as good as people are making it out to be. It's actually much, much higher than it's being made out to be. Okay. So making out the $910,000 job over estimate, the over half of those are just to do with the overestimate from the model. The second thing is to do with just the high death rate, like the ones that have not that lost their jobs almost before they got them, because these AI businesses are so ubiquitous and that they just aren't staying under. And then we've got our temporary construction jobs. Like you have some people that are just temporary workers that they're counted as new jobs, but then those jobs go away. And then there's data entry admin losses, not counted. This is people that lost jobs because they had a job and then they lost their job because the AI business started, and they lost their jobs to AI. And then you have your entry level positions vanish because you don't have people coming in to do the jobs that the AIs are doing, that there once upon a time these would have been jobs that people did. So AI is actually taking away more jobs than it's creating, and it's creating this illusion by all this money being invested into AI that there must be all these jobs, but it's actually not forming as many jobs as you would expect. And that's why you have these issues with AI, or with the job performance not being what you would think it would be. So when you look at everything together, between inflation is affecting people that are in the bottom 80% more. When you look at the tariffs are affecting people that are in the bottom 80% more. When you look at the ACA is affecting people that are in the bottom 80% more. When you look at the jobs are not what they really would, what the unemployment rate says, that actually it's much higher than that. And when you look at the everything in combination, when you look at the mass deportations that are affecting the smaller towns more and the farm towns more, because they just don't have people to come up and do the work, all of those things combined are making it much, much harder for people that are in the bottom 80% than in the top 20%. So what you have is those most Americans right now are in a recession. Whether or not it's officially recognized as a recession, their day-to-day living is a recession. They don't care about the difference between whether or not we're technically in a recession when they have to pull out their plastic to pay for food, or they starve, or when they have to pay for their heat with plastic, or else they freeze. There is a very real recession going on. This is not a projection. This is a reality. So we need to stop asking, when are we going to be in a recession? We need to start asking, when are we going to acknowledge we are in a recession? Because we are in a K-shaped recovery right now, but we're not having a recovery. We're digging ourselves into a recession, and it's only a matter of time before something with the credit card defaults start blowing up, or Donald Trump announces one too many terrorists, or the AI bubble bursts. We are very much in danger of getting into, arguably the worst recession of our lifetime. And, possibly even, I don't know if we'll get to Great Depression, but beyond recession, we could be entering a second depression. So that's my story, and I'm sticking with it. Once again, I'm Machine Pun Kelly. Thanks for watching. If you learned anything, please give me a like and subscribe.